What is happening, people? It is your boy Jack. You can see I'm in the all yellow today. We flex in the all yellow, and you can see right here it's a Monday. It is March 30th. It is the last Monday of this month, and the market opens in about an hour and 20 minutes. And a lot of you people are going to be looking at the market very closely this week and trying to figure out which stock should you be getting into. And that's what we're going to speak about today. I want to show you 5 consumer staple stocks that have outperformed the market during the bad times in the past, so during the Great Recession in the past. These are stocks that you can add to your portfolio that are relatively safe. They've been around a long time. They're massive companies. They're in the consumer staples, so people need these companies' products no matter what happens. Even if there's a worldwide pandemic, people need these products. Today we're going to be speaking about 5 of my favorite ones that I will be keeping personally a very close eye on this week. But right before we get into that, I just want to ask you, please smash that like button. The support on the channel has been absolutely mental as of late. We broke the 1,000 subs. We smashed through the 1,000 subs mark. So thankful to every one of you. If you're not subbed yet, boom, hit that sub button, boys. Let's keep this channel growing. But anyway, let's get straight into this. Here are the 5 stocks. Now, I don't think it would be possible to make a video on consumer staple stocks and not include the monster 272 billion market cap company that is Procter & Gamble. We can see straight off the bat we have a dividend safety score of 99 and a current dividend yield of 2.71%. This here is a company that anybody who is in the stock market knows about. Everybody has them in their portfolio. I don't know anybody who doesn't have these guys in their portfolio. They're just that believed in. So if you don't know who these guys are, you definitely know some of their products. Right now we're having a look at them. Tide Pods, Ariel, Bounty, Jarman, Fairy, Oral-B toothbrushes, Pampers. Always, for the ladies out there, Gillette, for the men out there, you know these products, you know what they are. You probably have at least one of them in your house right now. And that's where over 70% of earnings are generated by the company's fabric and home care, baby, feminine and family care and beauty segments. So most of their earnings are generated from products that people absolutely need regardless of how the economy is doing. So like, people are always going to need their laundry detergents and cleaning products. They're always going to need their baby wipes, their diapers, things along those lines. People are always going to need their hair care, you know, that head and shoulders to keep the skull looking quite nice. They're going to need toothbrushes. Everybody needs a toothbrush, and we're going to need our shaving products. So they sell things that everybody needs regardless of how the economy is doing. If you get laid off work, you don't go, Jesus, I'm gonna have to cut back on my toothbrush spending. That's not what you think of. You start thinking of unnecessary costs. Not your toothbrush, not your child's diapers, not your baby wipes, nothing along those lines. I don't want this video to last like 84 days, so I'm gonna try and be relatively quick on each stock. So I'm not gonna go into too much detail about what everything I speak about means. I have other videos on those things, but hopefully you're able to keep up. So they have an earnings payout ratio currently of 60% and a forecasted for the next 12 months of 59%, which is awesome. They're going to be able to keep paying their dividend in these tough times, which they have done in the past. Their stock outperformed the market during the Great Recession with a return of minus 36%, and the average from the S&P 500 was 55%. So they smashed the market to pieces the last time we went through such a tough time. And right now we're going through an unprecedented, horrible time that's already hitting stocks way worse than the Great Depression is. So that's a nice reason to be in a company like this that outperformed them the last time in recent history we went through a really tough time. And the last thing we'll have a look at, right, their PE ratio. So their forward PE ratio is 21.6, which is essentially its 5-year average of 21.5. That just means that the market is valuing this stock pretty much the same it has done for the last 5 years, so it hasn't necessarily gained or lost value in investors' eyes. So what this means to us investors is that we're probably getting in at a relatively fair price if we believe in this company in the long term. And the sector average is 16.5, so that means that people believe in PG more than the sector as a whole, which could be a good or bad thing. It could be a good thing because it means that we see they have more potential to grow than the average company in this particular sector, but it could be a bad thing because they may be a little bit more expensive than certain other companies. Personally, I just think it's such a safe bet, I'm not too worried about this. I think having it at a fair evaluation and getting into this at a fair price is great. And just one last thing, their net debt to EBITDA is at 1.52 and 1.49. Excellent, absolutely excellent. They're going to have no troubles getting through these tough times. Now is a good time to say though that if you're interested in any of the companies I speak about today, these are all my thoughts and opinions. I'm not a financial advisor, and what I'm going to speak about today is nowhere near enough information to decide if you want to invest in a company or not. I'm essentially just putting them on the radar so that you can go out and do more research into them. So in my opinion, this is an amazing company, but what we just went through is nowhere near. It's just the tip of the iceberg of the research you have to do if you are going to invest in them or not. Boom! Next up, we're having a look at Pepsi, baby. I actually put up a full video on Pepsi stock versus Coke stock just yesterday. Check that out after this video if you want to. But anyway, Pepsi. We all know who they are. They are in the beverages and snacks industries. They have a current dividend safety of 93. They have a current dividend yield of 3.17 and a market cap of 167 billion. And they've been paying out their dividend for 47 years. Where is it? So I can show you that's a fact. Here it is. An uninterrupted dividend streak of 47 plus years. Booyah, baby. And let's just have a look at this. So during the last financial crisis, they only dipped in sales by 0.5%. That could happen on any given year, so that's an excellent sign for us. And they outperformed the market and returned minus 35%. And again, the S&P performed minus 55%. So excellent. They bet the market during tough times, just like P&G. Now, this company's net debt to EBITDA was 2.2 for the last 12 months and 2 going forwards. Again, if you want more information on this company, I literally have a whole video about them and Coca-Cola, so check that out after this video. But again, I think these look like an absolutely amazing company going forwards. And again, this is a company that looks relatively fairly valued. Their current forward PE ratio is 20.5 and its 5-year average is 21.3. So again, it's at a relatively fair price. And again, just like P&G, this is above the sector's average. So people may expect this company to do better on average than other companies in the sector. So always worth keeping that in mind as well. People are relatively optimistic about how this company will do as a whole in the future. I couldn't speak about Pepsi and not speak about Coca-Cola. They're pretty much two peas in a pod, baby, with a current dividend safety of 80, a dividend yield of 3.83%, and they've actually been paying dividends for 57 plus years. Another dividend king. Boom, baby. These companies, they just give us so much hope, you know what I mean? They smashed through the last recession. They've been paying dividends this long. They have enough cash to get through tough times. That is why they are making it into today's video. And a little cheeky market cap of $184 billion. One thing I want to point out about these boyos, the earnings payout ratio is currently at 76%, which is a little bit higher than where we want it to be. But it's not the biggest deterrent in the whole wide world by any means. And again, here's a company, they didn't even lose 5% of their sales during the Great Recession, so they did a little bit worse than Pepsi, but they significantly outperformed the market yet again, and they returned negative 31% to the 55% S&P 500. So again, a company that smashed the Great Recession to bits. Here's where things get a little bit interesting for Coca-Cola. They have a forward PE ratio of 19.2, which is below its 5-year average of 22.5, which means it's cheaper. It's valued cheaper than it's been on average over the last 5 years, so it could be presenting us a great opportunity to get in. Now, on the other hand, that means that investors could be getting ever so slightly pessimistic about Coca-Cola and their future prospects. But ultimately, it is your decision to decide how you feel about this company going forward. I personally believe in Coca-Cola from all of the research I've done, so I love to see that they're actually slightly undervalued because it means that I will get in at a better price. Now, I know I absolutely flew through Pepsi and Coca-Cola, but that's because I have a whole video on them, so I didn't want to spend too much time on them. But now we have 2 more tasty little stocks to get to. Now, the next 2 companies are companies I've never spoken about on the channel and I don't currently hold investments in, but I really want to get into them over the next week or 2. So the first one we can see on the screen is Walgreens Boots Alliance. They're in drug retail. They have a dividend safety of 79, a dividend yield of 4.16%, a market cap of 39 billion, and they have been paying uninterrupted dividends for 44 plus years. So again, nearly a dividend king, a company that straight off the bat looks a lot like the previous 3 in regards to their dividend, their streaks, etc. So in case you don't know who these guys are, because you may well not, especially if you're not from the US, it's one of the world's largest pharmacy retailers and drug distributors, operating over 18,000 pharmacy stores around the world. So again, like I said with Procter & Gamble, Coca-Cola, Pepsi, these are things that people are going to need no matter what happens next in the economy. You know what I mean? If people have their prescriptions, if people need certain drugs, when you make less money, you don't think, oh, you know what, I'm going to get rid of my antidepressants. That's the first thing you're going to get rid of? No, you're going to get rid of the unnecessary stuff. You're going to keep getting your antidepressants and whatever other drugs you need. We'll look at a few more statistics for this company than the last 2. Earnings payout ratio, 30% for the last 12 months and a projected of 31% for the next 12 months. That's an excellent first sign. Now, a couple of points of note. They've generated positive free cash flow in each of the last 10 years. That's always something nice to see. They managed to increase its dividend during the recession, and they dropped 44% during the recession. So they didn't perform quite as well as the last companies did, but they still outperformed the market in general, which does classify them as a relatively safe investment. Here's where things get a little bit exciting and is what really makes me want to get into this company, okay? Their forward PE ratio is 7.5 and their 5-year average is 14.3. So it is extremely undervalued at the moment. People are very pessimistic about this stock. But again, at the end of the day, you have to decide how you feel about a stock's prospects or a company's prospects, not everybody else. And that's exactly what the next line says. If you believe that their health and long-term outlook remains solid, then the stock could be attractively priced, which is something that I do. Again, there's a lot more to deciding to invest in the company than what I have just shown you. If it was that easy, we'd all be multi-billionaires by now. There's a lot more that goes into it, so don't just take this as you should definitely go and buy this company. Now, here is one ever so slightly worrying thing, okay? Their net debt to EBITDA, the last 12 months was 4.12, which had come down ever so slightly from the year before, and it was projected to be 3.5 going forwards. So they are handling their debt better, but it's still not in a very good place. We can see that again with their net debt to capital. Why do I find that so hard to say? And again, we can see that with their net debt to capital. Yes, we did it! The last 12 months, it has been 0.63. So again, it is coming down ever so slightly, but can they keep this up? Who knows, especially going into these tough times. I just think it's important to remember that they have over 18,000 pharmacy stores around the world, and they should not get hit too hard because people are going to need their drugs, simply put. No matter what happens next, no matter how much money they have coming in, this is something that they will be prioritizing when it comes to, you know, budgeting their money. Now, our final stock, we're having a look at the world's biggest retailer, Walmart, who are sitting at a dividend safety score of 78, a dividend yield of 1.97%, a market cap of 310 billion, and an uninterrupted dividend streak of 46 plus years. Again, they're so close to that dividend king status. They're going to do everything they possibly can to protect their dividend in these tough times. Even if you're not from the US, you probably know who these guys are. They're the world's largest retailer, as I just said, with more than $500 billion in annual revenue over 11,000 stores. About half of their stores are located in international markets. However, the majority of Walmart's sales and profits are derived from the US stores, 64% of revenue, and Sam's Club 12%. And if you've ever been to a Walmart, you know that they sell just about everything from groceries to health and wellness products to general merchandise. They sell everything. The company's strategy is to be the low price leader in every product category. So again, that speaks good signs for them right now, because people are going through tough times, people are going to have less money, and they're going to go wherever they have to spend the least money to get the things that they need. And Walmart offers things that they need at competitive prices. They have an earnings payout ratio of 43% and a projected one of 42%, which is pretty fine. Below 40% is a preference. They're pretty much right at that mark. Now here's where things get really exciting. Right, so first of all, not too exciting. They've generated positive free cash flow in each of the last 10 years. Now let's get to the juicy stuff, right? The revenue grew 0.1% during the financial crisis, okay? They increased its dividend each year during the recession, and they returned plus 7% during the financial crisis. And the average stock went down 55% during the financial crisis. So they can do pretty well, to say the least, during tough times, and that is because of their business model. They want to be the cheapest, and people don't want to spend much money. Where are they going to go? The cheapest place they can. One more thing that makes them look absolutely beautiful: their net debt to EBITDA below 3 is the preference. Last 12 months 1.75. They've been well below this for the last 10 years, projected 1.73. They're going to be able to get through any tough times, and their net debt to capital is at 0.44, below 0.5 is a preference. So again, everything looks really nice for this company. It looks like one of the safest bets you could possibly have. When deciding what stocks we want to invest in the next while, at least from a short-term perspective, we want to somewhat protect our capital. We want to invest in long-term companies that we believe in long-term, that we believe will grow over the long term, over the decades to come. But we also want to protect our portfolios, and we want to invest in companies that potentially won't get hit as hard as the average company in the short term. So if we can invest in companies like Walmart that have an amazing track record when it comes to long-term growth and have also outperformed the market in tough times, that's exactly what we want right now. On a dividend yield of 1.97%, that's a little cherry on top. They still pay a dividend. Now, be wary, because a lot of people have the same thoughts that I do. Their forward PE ratio is 21.4, which is well above its 5-year average of 17.6. The stock looks pricey compared to how the market has valued it in recent years. So that means that you may be overpaying for this particular stock. Obviously, we like to get into stocks when they're undervalued because it leaves us more growth potential. And the reason it is overvalued is simply put because it is such an attractive stock to people. It's one of very few companies that increased their earnings, that increased their profit during the Great Recession, increased their dividend, have a dividend track record like Walmart do. So that is more than likely the reason it is overvalued, because in reality, it's worth it. So this is the company that I am not in just yet, and I will be keeping such a close eye on, really hoping that they take a hit so that I can get in at a very good price. But who knows, I could completely miss out. So guys, they are my top 5 picks in regards to consumer staple stocks right now. Hopefully you were able to find some stocks that piqued your interest, and you will go and do a lot more research than we did in this video alone and come form your own opinions. Because again, I'm just some random 22-year-old kid on the internet, baby. I ain't no financial advisor. If you did enjoy, yet again guys, please drop the video a like if you haven't just yet. Subscribe and hit that bell button so you never miss a video in the future. We're going to keep these daily uploads coming. Drop me a comment with your thoughts on any of the stocks we spoke about today. And until the next one guys, peace.